Welcome, folks. Today, we're diving into the wild and wonderful world of tax strategies for W-2 employees. Yes, you heard that right. If you're working for the man and getting those regular paychecks, there's still hope for you to dance your way through the tax season with a smile. So grab your favorite calculator and let's get this tax party started. Retirement contributions, picture this. You're sitting on a beach sipping a pina colada and your boss is a distant memory. How do you get there? Retirement contributions or home-based business income. W-2 employees, you can reduce your taxable income and set yourself up for a future that doesn't involve endless meetings. And here's the twist. It's not just about your future. It's about the saver's credit, a little something that puts money back in your pocket. Check out the 2022 cost of living adjustments for retirement plans and IRAs. You may be able to take a tax credit for making eligible contributions to your IRA or employer-sponsored retirement plan. Also, you may be eligible for a credit for contributions to your Achieving a Better Life Experience ABLE account if you're the designated beneficiary. Who's eligible for the credit? You're eligible for the credit if you're age 18 or older, not claimed as a dependent on another person's return, and not a student. You were a student if during any part of 5 calendar months of the tax year you were enrolled as a full-time student at a school or took a full-time on-farm training course given by a school or a state, county, or local government agency. A school includes technical, trade, and mechanical schools. It does not include on-the-job training courses, correspondence schools, or schools offering courses only through the internet. If you're a low to moderate income taxpayer contributing to retirement, you could snag up to $1,000 for singles and $2,000 for lovebirds in tax credits. That's like extra sprinkles on your financial ice cream. Health savings accounts. Let's talk about HSAs, the superhero of healthcare finance. If you've got a high deductible health insurance plan, these bad boys are your sidekick. Your contributions are tax deductible, which means you're saving money while saving lives. Well, sort of. But wait, there's more. If you use your HSA for eligible dependent care expenses, say hello to the Child and Dependent Care Credit. It's like a tax rebate for the unsung heroes of parenting, the ones who need a little extra help while you're at the office. Education expenses. Are you thinking of expanding your knowledge? Good news. The tax man has some love for you too. If you're pursuing education, the American Opportunity Credit and Lifetime Learning Credit are here to make you the tax-deductible scholar you were meant to be. So grab those textbooks and start your journey to genius. And for those hustlers with lower incomes, the Earned Income Tax Credit, EITC, has your back. It's like a financial high five for those working hard to level up their career. Education and tax credits. The Earned Income Tax Credit, EITC, helps low to moderate income workers and families get a tax break. If you qualify, you can use the credit to reduce the taxes you owe and maybe increase your refund. Did you receive a letter from the IRS about the EITC? And do you qualify? You may claim the EITC if your income is low to moderate. The amount of your credit may change if you have children or dependents are disabled or meet other criteria. It's a win-win. Homeownership. Do you own a piece of the American dream? Well, your house could be the gift that keeps on giving. Mortgage interest and property taxes are like secret agents, stealthily reducing your taxable income. But hold on to your hard hats because there's more. If you're making your home energy efficient, you might be eligible for the Residential Energy Efficient Property Credit. Solar panels, here you come, and with a side of tax credits. The following energy efficient home improvements are eligible for the credit. Building envelope components, satisfying the energy efficiency requirements in Q1 under the Energy Efficiency Requirements section. Exterior doors, 30% of costs up to $250 per door, up to a total of $500. Exterior windows and skylights, 30% of costs up to $600. And O insulation materials or systems and air sealing materials or systems, 30% of costs. Home energy audits, 30% of costs up to $150, CQ5 under the General Questions section. Residential energy property, 30% of costs, including labor, up to $600 for each item. Satisfying the energy efficiency requirements in Q1 under the Energy Efficiency Requirements section. Central air conditioners, natural gas, propane, or oil water heaters, natural gas, propane, or oil furnaces and hot water boilers, and improvements to or replacements of panel boards, sub-panel boards, branch circuits, or feeders that are installed along with building envelope components or other energy property listed in these FAQs and enable its installation and use. Heat pumps and biomass stoves and biomass boilers, 30% of costs including labor, satisfying the energy efficiency requirements in Q1 under the Energy Efficiency Requirements section. Electric or natural gas heat pump water heaters, electric or natural gas heat pumps, and biomass stoves and biomass boilers. There is a $1,200 aggregate yearly tax credit maximum for all building envelope components, home energy audits, and energy property. Electric or natural gas heat pump water heaters, electric or natural gas heat pumps, and biomass stoves and biomass boilers have a separate aggregate yearly credit limit of $2,000. Thus, the maximum total yearly energy-efficient home improvement credit amount may be up to $3,200. Charitable contributions. Finally, we're diving into the world of giving back. Donating to charities is not just about warm fuzzies. It's about cold, hard tax benefits. Your contributions are deductible, which means they lower your taxable income. And who doesn't love a smaller tax bill? But wait, there's more. Charitable contributions can even lead to extra goodies. The IRS imposes record-keeping and substantiation rules on donors of charitable contributions, and disclosure rules on charities that receive certain quid pro quo contributions. Donors must have a bank record or written communication from a charity for any monetary contribution before the donors can claim a charitable contribution on their federal income tax returns. Donors are responsible for obtaining a written acknowledgement from a charity for any single contribution of $250 or more before the donors can claim a charitable contribution on their federal income tax returns. Charitable organizations are required to provide a written disclosure to a donor who receives goods or services in exchange for a single payment over $75. Like, follow, and subscribe for more tax savings information. For information about organizations that are qualified to receive charitable contributions, see IRS Publication 526, which describes contributions you can and cannot deduct and explains deduction limits. Thanks for visiting the VRMSZ Tax channel, where we share the hidden facts.